All right, everyone. I think we can go ahead and get started. Um, I'm Nelda Fields, Director of Webster-Rogers Healthcare Services Group. I'd like to welcome everyone to this educational series, and especially the South Carolina MGMA members. These virtual events we hope will bring and meet some of your educational needs since we're not able to come together at the annual conference in Hilton Head. The series will cover various topics, and we have guest speakers presenting throughout this series. For more information on the series, please check the South Carolina MGMA website and the Webster-Rogers website. I would like to thank MGMA for allowing us to help them meet their educational needs and to be a resource as needed. For today's topic, we're bringing you some of the latest information under the CARES Act. We'll be highlighting information related to the Paycheck Protection Program and the HHS Provider Relief Funds. Our subsequent sessions will focus on COVID-19 changes and the various waivers that have opened up challenges and opportunities to new ways of delivering care, coding and billing for services, and addressing compliance and audit issues. Our next session will be addressing telemedicine and remote patient monitoring. Then we have planned a session to move you closer to understanding value-based care initiatives as you all see the shift from fee-for-service to fee-for-value. This is certainly evident with CMS and the major commercial payers. Last, we have planned a session on coding and compliance and a look ahead at changes for 2021. I'd like to take a few minutes to introduce our speakers for today's session. All of our speakers are with Webster-Rogers. As I mentioned earlier, this is group. I've been with Webster-Rogers for the past 16 years. I bring industry operational and financial knowledge to keep up with the ever-changing healthcare industry environment. My background has been in healthcare systems as well as independent physician groups. Like many of our MGMA members, I'm a fellow in the American College of Medical Practice Executives and with the Healthcare Financial Management Association. I strive to focus on understanding and bringing solutions in the areas of operations, reimbursement, regulatory, as well as revenue opportunities and process efficiencies. I work with a great team of professionals here at Webster-Rogers, as well as our alliance firm and other third-party partners to bring solutions. I'd like to just take a few minutes to go ahead and introduce our speakers for today's program. John Leahy is a certified public accountant with Webster-Rogers. He brings over 40 years of experience assisting medical and dental practices. John has a focus on the practice management, accounting, and compensation issues. He has extensive knowledge in tax planning and preparation for corporations, partnerships, and individual providers. John is also very versed in the employee benefits for pension and profit sharing, as well as health insurance and HSA programs. John's a certified financial planner, and John is one of the lead tax professionals on our COVID-19 task force team. Josh Draco, healthcare consultant with us, joined Webster-Rogers back in 2018. Josh has over a decade of experience working in the healthcare industry, focusing on operational and revenue cycle improvements. He has experience from his past jobs with primary care, urgent care settings, and acute care settings. Much of Josh's focus lately has been on MIPS reporting, revenue cycle optimization, staff training, credentialing, and compliance audits. Josh also supports our COVID-19 task force team on the provider relief funds, along with myself. We also have Tim Sinclair. Tim Sinclair is our industry consulting director with Webster-Rogers. Tim has been with the firm since 2015. Tim brings nearly 2 decades of experience in consulting and manufacturing companies. He's worked with more than 350 companies across the state in various industries, and development with strategic planning and leadership development. Tim drives top-line growth with strategic marketing and business development initiatives. Prior to employment with Webster Rogers, Tim was the regional vice president for the South Carolina Manufacturing Extension Partnership. Tim has served as our lead on the Webster Rogers COVID-19 task force team. Now, just a little bit about Webster Rogers. The next following slides. Webster Rogers is a leading South Carolina-based accounting and consulting firm. Here in South Carolina, we have a broad spectrum of services across audit, tax, and advisory services. Our firm was built in the 1980s on the principles of quality, integrity, and dedication to service. Our Webster Rogers Healthcare Services team focuses on all the areas of accounting, tax, payroll, and healthcare specialty services. We're proud to work within the healthcare industry to drive revenues, efficiencies, and knowledge. And again, an array of solutions that our team brings. We would like to just mention that during the presentation, during the Zoom presentation, you may want to just have the speaker view, as that will allow you to have optimum view of the PowerPoint presentation. And also, during the sessions, you're welcome to submit questions through the chat capability. And at the end, we should have questions to the group, as well as we'll be glad to follow up with any questions that we do not have time to get to. Again, I would also like to give a big thanks to all of our healthcare team members, particularly Beth Hyman and Josh, who have helped us put together this, this presentation, and hopefully y'all enjoy it. Tim, I'd like to turn the session over to you now.
Great. Thank you, Nelda. I really appreciate it. Hopefully everybody can see me. See if we can get the technology to work. So today, I really appreciate being with you guys. I appreciate MGMA giving us the opportunity to do this. I'm going to be covering the Paycheck Protection Program, which I'm guessing many of you are participating in your practices. So the PPP program, just to you, and what I'm going over with you today is fewer slides that are going to be available. Given the time constraint, I'm going to focus primarily on the forgiveness aspect, but like I said, all the slides will be available to you, and there's going to be additional slides to what I'm going over today, talking about the different aspects of PPP, like costs and things like that, that you may already be aware of. But the most pressing things that we're dealing with clients right now is the forgiveness, and so I want to focus on that. So to begin with, you know, it was amazing how quickly this came about between the CARES Act being passed and when they started this. But the reason it is because basically we're making up the rules as we go. I threw up this slide just to give you a sense of how many interim final rules have already been posted. And these IFRs are what's creating the rules for the program and defining things within the program as we go along. So there have been 24 of them. The most recent was last Monday. So I put this up as an illustration to say things are still changing with this program. So you need to be aware of that. See if I can get this to advance. All right, so high level, you know, from the original CARES Act, they did pass a Flexibility Act. The way that the program looks now, what we're dealing with, there is a 24-week forgiveness period. I'm sure many of you know that from the original 8 weeks. The term of the loan is 5 years, where the original one was 2. However, most companies did get their PPP loan prior to the Flexibility Act passing. So the term of the loan doesn't change unless you go and talk to your bank about that. So be aware of that. The first payment deferral, this is important. Originally, it was 6 months. The Flexibility Act changed it. So first payments aren't due until 10 months after the end of your forgiveness period. If you look at a calendar, do the calculation, the first payments on these aren't going to be due until July of 2021. I say that just to underscore the fact that there really isn't a huge rush at this point to get these in, and it may be prudent to hang off or hold on a little bit, not rush into forgiveness. And the last major change the Flexibility Act had in it was it changed it from a 75% of the forgiveness amount must be spent on payroll costs to 60%. I do want to, like I said, jump into forgiveness. High level, to receive 100% forgiveness, we need to spend all of the loan money on qualified expenses during the covered period. I'm not going to go into details or talk about what qualified expenses are. Hopefully, many of you have been through many of these webinars already, understand what those are. In the slide deck that you'll get, it does go over what these qualified expenses are, so you can reference that, and certainly we're happy to answer questions about that. Beyond spending the money, we say that we're not going to reduce any employees' pay by more than 25%. That's a requirement. We keep the same number of full-time equivalent employees during the covered period. We'll get into detail about that. And obviously there is an application process along with required documentation. And we'll talk a bit about that also. So to jump into this, the first is this salary wage test, where we say we're not going to reduce any person's salary or wage by more than 25%. I'm going to hit this at a high level. We don't have many clients that this has applied to, because in all honesty, most folks have not reduced salaries or wages. That hasn't been the biggest issue. But to talk about this, the benchmark or comparison period you're going to look at is January 1st, 2020 to March 31st to 2020. So you look at Q1 pay to individuals, and that's what you're going to compare the pay during the covered period to in order to determine, have we paid them at least 75% of their wage or their salary. It is important to note that salaries and hourly wages are compared differently. Salaries are annualized for comparison versus hourly wages, which is just the rate is compared. So for salary, as an example, you look at Q1 salaried employees, what they were paid, you multiply that by 4, you get their annualized salary. During your covered period, you look at what you pay a salaried employee, then you annualize that by using the correct multiple, and you say, okay, you compare them and say, did we pay at least 75%? On an hourly wage, you look at the wage rate. So as an example, if someone was earning $20 an hour in Q1, they would need to be earning at least $15 per hour as a wage rate during the covered period in order to meet this criteria. An important note is that any employee making more than $100,000 per year rate for any pay period in 2019 is excluded from this test. That equals about $38.25 on a biweekly pay period. And so let's say you have an employee that makes $75,000 a year, but potentially during a pay period you gave them a bonus in 2019, which bumped them above that rate. Where they made, say, $4,000 in a pay period due to a bonus, that would actually then exclude them from this test. So that it is just a nuance that I wanted to make you know. A more pertinent test, or a more, a thing that seems to be more applicable to many of our clients, is this FTE test. I apologize, let me go back. There we go. Okay, so the full-time equivalency test, we must have at least the same average number of weekly FTE employees paid during the covered period as compared to the borrower's chosen reference period. The difference here is, instead of, you actually have some choices for your reference period. So you can use January 1st through February 29th of 2020 as sort of your benchmark period. You can use February 15th, 2019 through June 30th of 2019. Or for seasonal employers, you can use either of those periods or any consecutive 12-week period between May 1st and September 15th. FTEs are calculated using 40 hours per week. When they came out, they said anybody working 40 hours per week or more is considered one FTE. And if they're working less than that, there's two methods that you can use. The straightforward method is you look at the average hours per week they work, you divide by 40, then you get a decimal number and you round that to the nearest tenth with a cap of 1. Or you can use a simplified FTE method whereby anyone working 40 hours per week or more, it counts as 1, and anybody working less than 40 hours per week counts as a 0.5 FTE. And I'm going to go through just a little bit of an example just to show you, because it's probably easier to show you than explain it. Let's see. In just a second, I'm hoping my slides will advance. Okay, hopefully it doesn't advance more than that. Okay, so in this is using the reference calculation example. So for this employer, they have 4 employees, A, B, C, and D. We're using a January 1st through February 29th benchmark period for this. Employee A worked 47 hours per week on average, employee B 40, employee C 34, and employee D 13. So what I wanted to illustrate is the difference in how using sort of the straight up method would compare to a simplified method and how you can get a different result. So in this, if we're using sort of the straightforward method, employee A, is one FTE, employee B is 1 FTE. Then when we divide by 40, the 34, you get a decimal number rounded to the nearest tenth of 0.9. And then the 13 hour per week employee counts as 0.3 FTE. So for this example, they average 3.2 FTEs during their benchmark period, which is what they would want to hit during their covered period. Using the simplified method, where anyone working less than 40 hours per week counts as a 0.5, you can see that their FTEs are actually lower at 3.0. This is really just to demonstrate that it is important to potentially look at the different benchmark periods you want to use and potentially run it in a couple different ways using the simplified method and the regular method to see what gets you a better result. If you do use the simplified method for your benchmark, you do need to use that for your calculations during your covered period as well. All right, let's go back. All right. Next, there are several FTE reduction exceptions, and there are a couple of safe harbors that I want to make sure everyone's aware of. This speaks directly to the forgiveness. So the reduction exceptions, any positions that you let go after February 15th, but then you made a good faith written offer back to rehire that employee, but they decided not to come back, and you were not able to fill that position with a qualified employee by December 31st, it does not count against you in your FTE calculations. The second is any position where you might have reduced the hours of an employee, which could have an impact on their FTE calculation. Then you offered that person the additional hours back at the same rate or wage, but they rejected the offer. That does not count against you. Lastly, any employees that were fired for cause, they voluntarily resigned, or they voluntarily requested and received a reduction in hours, those FTEs do not count against you in your calculations. There are 2 safe harbors which you need to be aware of also. This first one is especially important because it could enable you to use an an easy forgiveness application, which I'll talk about a bit. But this first safe harbor is you're able to document that you're unable to operate between February 15th and the end of your covered period at the same level of business activity as before February 15th because you are complying with guidance issued by HHS, the CDC, OSHA, or other related types of entities. Where this comes into play is, obviously we had a lot of state orders of shutdown orders and things like that. If complying with any of those orders caused you to have a decrease in business so that you weren't able to operate at the same level, you potentially are going to qualify for this safe harbor, which would also enable you to use an easy application. So that's the safe harbor number 1. The second safe harbor to be aware of is if you did have a reduction in FTEs between February 15th and April the 26th, you have the opportunity to get back up to your February 15th levels by December 31st, 2020. Okay, so if something happened between February 15th and April 26th, you let some people go, you furloughed some folks, that's documented. As long as you're able to get back up to that February 15th level of FTEs, you're going to be okay from a safe harbor perspective. All right, for the forgiveness applications, there are two applications currently. I apologize, let me go back. There are two current applications. You have the full application, which is Form 3508, and then you have an EZ application. This EZ application is for companies that qualify, that qualify for the safe harbors, and or they basically can certify that they did not have a reduction in FTEs. It removes Schedule A and the Schedule A worksheet, where you don't have the salary and wage and the FTE reduction calculation. So it's a little bit easier, less cumbersome application. So I just want to go through quickly the three criteria. You have to meet one of these in order to use the EZ application. The first is that if the borrower is self-employed and they don't have any employees at the time of their application, okay? Pretty straightforward. The second is you're certifying that you did not reduce any wages by more than 25% during the covered period, and you have not reduced the average your number of FTEs during the period. So you need backup for this. If you're saying I did not, reduce any FTEs just straight up, then that's fine. The third one, and this is that other FTE safe harbor, is if you can certify that you did not reduce anybody's annual salary or hourly wages by more than 25%, and you were unable to operate during the covered period at the same level of business activity as before February 15th due to compliance, as we've discussed, then you can use the EZ application. High-level forgiveness process, just so you get a sense of it. You can submit an application with all the required documentation to your lender on or before the maturity date of the loan, including before the end of the covered period. One of the IFRs that came out basically said you don't have to wait until the end of your 24-week covered period to submit that application to the bank. Once you submit an application, the lender then has 60 days from the receipt to review it, make a determination, and then submit that to the SBA with their decision. The SBA then has an additional 90 days to review that to let the lender know, yes, we agree, no, we don't, this is what you're going to get forgiven. And at that point, you as the borrower would be notified. Again, to reiterate, if you don't apply for forgiveness within 10 months after the last day of your covered period, the payments are no longer deferred and first payments will be due. Again, the earliest would be July of next year before that happens. One other thing that I did want to mention, and I failed to mention it earlier, this is regarding qualified expenses. The most recent IFR that came out last Monday dealt with paying rent to a related entity. Many of the doctor's practices and medical practices that we work with, they have a building that's in a separate entity, but has similar ownership as the medical practice itself. What came out in that guidance said that if there is rent or lease paid to a related entity, so if the doctors or the people who own your practice are the same or have any common ownership with who owns the building that you pay rent, the entire rent amount is not going to be eligible for forgiveness. Only the mortgage interest associated with that property is going to be eligible for for forgiveness. So that is something that you need to pay attention to. Happy to talk more about it. We've sent out a couple notices about that. Hopefully it won't impact too many people with the 24-week forgiveness. I'm hopeful that most people can use exclusively payroll costs for their forgiveness, but it is something, a change that was made. Lastly, our thoughts and advice. Potentially more changes are coming. For those of you who don't know, the next stimulus package, even from Congress and the Senate bills, have things in it that could make forgiveness easier, especially for smaller loans. There's discussion that loans under maybe $150,000 could be automatically forgiven with a simple certification. Additionally, there's discussion where any loans under $2 million, they can submit an application for forgiveness, but not have to submit all of the backup documentation. All that to say, at this point, there's no rush, and it seems that the majority of the new rules being made and the legislation being passed is going to help borrowers. So considering holding off applying for forgiveness unless you need to could be prudent. With the 24-week forgiveness, I would certainly consider as a borrower using all of your costs for payroll. That could reduce the amount of documentation that you have to provide to the bank as backup without having to provide, bills for electricity, rental agreements, things like that. Regardless, every lender could have a different process to do this. Some may have their online portals. Some may have their own applications to use. If you haven't done so, it would be good to get with your lender to understand their process and their requirements of what's going to be done. When we went through the original loan process, every lender was a little bit different. So most lenders, I'll say right now, it seems like they're not accepting loan forgiveness applications simply because they recognize that things are still changing and they want to wait until they get all of the rules before they start accepting those. Lastly, the FTE calculations we went over briefly, but it would be important and good for you to run your FTE calculations just so you know where you stand for your benchmark period and also for your covered period. So that would be our main advice at this point. I really appreciate all your time with that. We'll be happy to answer questions at the end. Now I want to turn it over to John Leahy, Director with our Healthcare Services Group, to talk about tax issues surrounding the CARES Act. John?
All right, thanks, Tim. That was a lot of information to cover in a short time. After people got their PPP loans and these other stimulus checks and so on, some of the first questions that we got is, how are these items going to be taxed? And there was a lot of talk originally about PPP loans being tax-free, and in a way they are. I want to cover the taxation of the PPP loan forgiveness issues, and then also talk about some payroll tax deferrals. And these are both employer and now employee deferrals because of the recent press release that President Trump put out saying that employees after September 1st may be able to defer their Social Security taxes through year end. So we'll talk a little bit about that. And then there are some employee retention credits that come into play. And I also just want to touch on some HR issues in medical practices. I don't think I'll have much time to cover that, but there'll be some slides that may help you out if you have questions. When it comes to the PPP loan forgiveness, it doesn't matter whether you're using the 8-week period or the 24-week period. The question is, how much of the loan is forgiven and how will that be taxed? And as I said, originally they were discussed as tax-free loans. And in a way, any loan is tax-free. When you receive loan proceeds from the bank for any reason, those monies are not taxed to you, and you get to deduct the expenses that you pay with those loan proceeds. If you look at it from an historic perspective, it's the cancellation of the debt that triggers the income. And the only exception you have under normal circumstances is insolvency. So if you had credit card debt and it were forgiven, that would be taxable income to you unless you could prove that you were bankrupt. But for PPP loans, they're basically, the purpose was to allow employers to retain their employees, to continue to incur the expenses for payroll, rent, utilities, and so on. So they got the money to the employer at no tax cost, and then you use those proceeds to pay what would be deductible expenses. And the same is true with the HHS stimulus money that came in from Medicare and also the Medicaid monies that Josh will be talking about later. The problem is, for a cash basis taxpayer, you want to match the income and the expenses. And normally expenses are deducted when paid, and the loan proceeds would be income when forgiven. And since most people are on a calendar year, this isn't a big deal because the loans came in the second quarter, and should be forgiven by the end of the year. That would be the end of the 24-week period, even if you got your loan as late as June 30th, would still be within this calendar year. The problem comes up when you have a fiscal year, and we do have a fair number of entities who report on a fiscal year ended June 30th, for instance. A lot of medical practices and nursing homes and other facilities operate on that year end. And for them, they would have gotten the loan in the second quarter and paid expenses during that second quarter. They won't know about the loan forgiveness until later. So they may need to get extensions on their tax returns and be very careful about how they account for those transactions, because the intent is to have a matching. Both the AICPA and IRS have come out with regulations that basically state that if you pay an expense and it's money that's going to be used to gain forgiveness, then you really need to not deduct that expense or pick up taxable income for the forgiveness, however you look at it. So that's going to be the problem, I think, would be for any entity not reporting on a calendar year. But for everybody else, you'll get the loan proceeds in, you'll use those proceeds to pay deductible business costs, and so to really be tax neutral. Many other pieces of legislation had taxes added when they were passed, like the Affordable Care Act added the Medicare surtax, or the net investment income tax. The purpose of all of this legislation is to get more money in the hands of businesses and individuals. So everything is favorable to the taxpayer. And they came out with rules regarding payroll tax deferrals for employers. So if you continue to pay your employees, the Social Security portion that the employer pays, the 6.2% that the company pays, could be deferred. And all employers are eligible for this deferral. The payroll period that can be deferred is anything after March 27th on through till December 31st. So basically, second, third, and fourth quarter wages are eligible for this deferral of tax. But you have to actually defer the payment of the taxes to get the benefits. If you pay your normal tax deposits in, you can't get a refund by claiming an overpayment when you file your 941 at the end of the quarter. So you actually have to pay less in, and then those are deferrals, and the taxes have to be paid back over time. See here on this next slide. So an employer is entitled to defer deposits or payments of employer's share of Social Security taxes, and even tax-exempt employers are eligible. Now, there are some interplay with different other tax credits, like the work opportunity credit. If you're a tax-exempt entity and you're hiring veterans and getting other credits, there can be some interplay there. But basically, the taxes get deferred in this year, and then they have to be paid back by the end of 21 and 22, 50% next year, and the remaining amount in the year 2022. So all it is timing. So it's like an additional loan that's available to employers, but one that many would need in this time of cash flow problems. They didn't want to leave anyone out on this, so self-employed individuals can also defer, and even household employers. If you have a household employee and you have to pay Social Security taxes on behalf of that employee. But these are a little trickier because those are paid more on a calendar year basis. So it's not so much a deferral as it is you don't get charged a penalty if you don't have that amount of tax paid in. And the rules are pretty complicated on how to allocate that tax for a self-employed person. But they just wanted to make sure that they were all inclusive in giving this benefit to any type of employer. And then another item I want to talk about here that's also advantageous for employers who retain their employees is something called the Employee Retention Credit. So this only applies to businesses that actually experience an economic slowdown, a hardship, or were forced to close, as Tim mentioned, due to government regulations that, cause gyms or hairdressers or whatever it might be to close their businesses. Now, for the most part, healthcare practices did not close, but they were significantly impacted. So to apply for the credit or to obtain the credit, your business has to have a reduction of at least 50% of the income it received in the same quarter of the previous year. So that is a calculation that's hard for some to meet, but if you can show that your income is reduced by more than 50% in that quarter and going forward, you would be eligible for this credit. Now, the credit is also based on the number of employees that you have. As Tim talked about FTEs, the FTE rules here are very similar to the Affordable Care Act. If you have 100 or more full-time employees calculated in a similar way to the Affordable Care Act, then you fall under a different set of regulations than if you have less than 100 employees. And the difference basically is that if you have more than 100 employees, you can only include the wages that are paid to those employees for not providing services. In other words, if they're there working in the business and providing services, you can't count it. But if you're paying them and they're not able to come into work and render services, then they would be eligible. But for a smaller employer with 100 or fewer FTEs, all wages paid can be included. And those wages even include items like vacation pay and sick leave. Any type of reimbursement made would be eligible for the credit. The credit is 50% of the wages paid during the calendar quarter affected, up to $5,000. So it can be fairly significant. And for some businesses that were adversely affected, it can be a real boon to them. Having trouble advancing the slides. There we go. So I covered that. And well, that was basically about it. So that employer retention credit can be computed at the end of the year once you're determined how much of it you would qualify for. It is a federal tax credit deductible directly against tax. Of course, there were many other benefits that came out, the individual stimulus checks that came out, unemployment that was extended to employees, and I'm not going to touch on the taxability of those items at this time. But the only other thing I wanted to mention is the HR concerns that are going to come up. Here we go. If you have an employee that comes to the employer and says that they are not able to report for work because they themselves are sick from COVID, or they have family members that are sick from COVID and they need to take care of them, or there's childcare issues, I think employers are going to need to make accommodations for them. There are many rules out there under existing laws like OSHA and the more recent Family First Coronavirus Response Act that put criteria in there as to how employers need to accommodate employees who are impacted. And fortunately here in South Carolina, we haven't seen high levels, but in some larger metropolitan areas, they are much worse. And I think the message here is that you can't just dismiss an employee because they don't show up for work one week if they have a legitimate concern over COVID. It is deemed to be a serious health hazard, and as such, you really need to consult either your attorney or just look to the laws that you have. You may want to consider reporting the incident for workers' comp, report it in your OSHA log. And like I say, just consider all of these things prior to a quick dismissal. There are some lawsuits, I think, that are already stemming from this, and just something to be mindful of. So that's pretty much what I wanted to cover. We'll certainly have time available at the end to open it up for questions if you have any. And with that, I will turn it over to Josh, our consultant, who's going to talk about the HHS stimulus money. He's spearheaded the team that has especially helped with the Medicaid applications of late. So go ahead, Josh.
Thank you, John, and thank you, Tim and Nelda, for the introductions and such good information. And a big thank you again to the South Carolina MGMA leadership team. We know that trusting us to be speakers is a big thing, and we don't take your trust lightly, so thank you. So like John said, my name is Josh Drago, and I am a healthcare consultant here at Webster-Rogers. As the world has struggled to address the COVID pandemic, part of the federal government's response has sought to provide financial assistance to various providers that are on the front lines fighting. This effort has been dubbed the Provider Relief Fund, and that's going to be my topic for today. There we go. So I'm going to be covering a few different things. I'm going to go pretty quickly through most of them, but I am going to linger a little bit longer on the terms and conditions and what to expect for reporting requirements. So I'm going to be covering the basics, what distributions have been made and what timeline they followed, and then lastly, talking about the terms and conditions and what to expect for reporting. Okay, so there we go, the basics. The Provider Relief Fund is a portion of monies allocated within the Coronavirus Aid, Relief, and Economic Security Act, or what we know as the CARES Act, which was signed into law, like Tim said, on March 27th. It consists of $175 billion, with a B, billion, to be distributed to healthcare providers who are combating COVID-19, and it's going to be distributed in several different phases, and I'll get to that here in just a second. It is administered by the Department of Health and Human Services, and then if the terms and conditions are met, distributions do not have to be paid back. So that's a pretty common question we get from providers, but as long as you have to pay these back. There we go. Okay, so that's the basics. Now let's talk real quick about the distributions and timeline. So the phase one was $30 and $20 billion distributed. The first was just a general distribution. Providers did not have to apply for this. It was automatically given based on last year's Medicare revenue for those providers. It included over 300,000 providers nationwide. And that differs from phase two because phase two, providers had to apply for. Phase two included CHIP Medicaid providers, dental providers, certain Medicare fee-for-service providers who either received a phase one payment but rejected it, those who did not receive a phase one payment or believe they are eligible for an additional payment, or any providers who were eligible for a phase one payment due to a change in ownership. And I know that's a mouthful, but if you have any questions and think that maybe you're eligible but you haven't applied for phase two yet, then by all means, get in touch with us. We can help work through that with you. So the resulting payment from phase two would be 2% of your annual net revenues from your most recent tax filing year. And for most people, that's going to be 2019. Now, the deadline for phase two, I'm going to talk about that for a quick second because phase one is in the history books. It's done. Phase two is not. They've extended the deadline several times to now the most recent deadline is September 13th. So again, if you believe that you might be eligible for funds from phase two's distribution, reach out to us. Let us help work through that with you. We can make sure we get you those funds. All right, so those are the phases, and they were pretty cut and dry. But the targeted distributions is where it gets a little more hectic. So like I said, though, I won't spend too much time on these, but just cover them real briefly. A lot of money has been distributed through the targeted distributions, but as you can see, they're mostly focused on rural safety net hospitals and what they call high impact COVID hospitals. Those are initially in the first round of high impact COVID hospitals was if a hospital had 100 or more COVID admissions. But now in the round two, which I think is on the next slide, is they upped that to 160 or more. There we go. And then lastly, they distributed funds to skilled nursing facilities, nursing homes, and then in August to certain children's hospitals. And okay, so those are all the distributions. timeline. So you can kind of get a picture of going through time here, how busy HHS has been. The CARES Act was signed into law on the 27th of March, and then April 10th is when the first round of phase one, their general distribution was passed out. So that's about 2 weeks or less. And if you think about the infrastructure that had to be put in place, where HHS had to gather all the data from all of these 300,000 plus providers, figure out how much of the CARES Act Provider Relief Fund first phase one general distribution they were going to get, and then to actually distribute those funds accurately while minimizing fraud. That's pretty remarkable that it was that quick. Let's see. Oops. Okay, and then in May, there were several targeted distributions going to rural hospitals, high impact hospitals, skilled nursing facilities, and then the tribal hospitals. And then June, again, more targeted distributions. And then August, here we are so far. Well, so far, August is over now. We had 2 targeted distributions sent out in August. So that's the timeline. You can see, like I said, that HHS has been pretty busy. So if you feel like you are eligible for phase 2, like I said, phase 1 is over and done with, but phase 2 is still open. So by all means, don't delay, don't wait until September 13th to apply. Make sure that you apply ahead of time. And if you have any questions, by all means, reach out to us and we can walk you through that. All right, so terms and conditions. All right, this is where it gets down to the nitty gritty. So we've covered the basics, we've covered the distributions, and now the timeline. We hear a lot of questions about the mysterious reporting requirements. And you might say, well, Josh, I've received my funds. I'm keeping track of my COVID-related expenses, like they say too, but it kind of feels like I made a deal with the devil because I still don't know what information I'm going to need to submit for the reporting requirements. How do I navigate this? That's a great question. The short answer is that HHS has intended to publish the reporting requirements by August 17th. And there was another date before that. They said that they were going to publish them by, but they pushed it back. And then they pushed it back on August 17th again. They have, however, given the following guidelines in the terms and conditions, and the final reporting requirements are expected to be pretty much in line with these. So number 1 there on your screen, the funds are supposed to be used, and again, this is in the terms and conditions that if you receive the funds that you agreed to. Number 1, the funds are supposed to be used to prevent, prepare for, and respond to COVID-19. So if you think about where to go. Number 2, and this is a little bit of a longer bullet point than number 1, but no balance billing for COVID testing. So under the CARES Act, out-of-network providers must receive from insurers, and this is quoted here, an amount that equals the cash price service as listed by the provider on a public internet website. So whatever the publicly posted cash price of the COVID testing is, that's what providers are supposed to get from out-of-network providers and in-network, okay? Now, cost sharing is allowed, but only at in-network rates. Providers must accept these in-network rates, also the treatment of COVID-19. Under the Provider Relief Fund's terms and conditions, again, recipients cannot balance bill a patient for the treatment any amount in excess of in-network rates. So if you are seeing an out-of-network patient, you have to bill them as if they were in-network, all right? So there's been about $100 billion allocated for uninsured COVID-19 patients as well. But providers are not to bill uninsured patients at all. What you do is keep track of that, and then on HHS's website, there's actually a portal where you can submit those claims for reimbursement directly from HHS. They have, like I said, that $100 billion set aside to pay uninsured patients. Number 3 is that the funds are only to be used, okay, what are lost revenues and what are expenses related to COVID-19? Again, that's a great question. Number 1, operational changes. So have you added extended hours, or maybe have you done a COVID-specific testing clinic? Point B there, reduced capacity or closure. I think that's pretty self-explanatory, but I know a lot of facilities, a lot of practices just closed outright for a few weeks to keep their staff safe. That would be considered within lines. An agency, have you had to go into overtime because you had some staff members that had to be at home taking care of their kids, or they were out with COVID itself, or what have you? Point D, new equipment. So plexiglass dividers. I've seen a lot of practices that have that. Extra sanitizing stations. Any of those type of expenses, make sure you're keeping track of that. How about increased supplies costs? What about PPE, right? So now we've got to change out masks after every patient. We've got to, I mean, we should be changing out gloves, but you've also got the increased hand sanitizer, you've got the increased wipes. All of these increase in costs, make sure you keep track of that. Investment in infrastructure, space, or technology. All right, so what if you're investing in a courier service for samples? I know in South Carolina, for the most part, the state, DHEC, actually transports those samples, but in the off chance that you had to come up with a courier service, improved Wi-Fi bandwidth, right? So you don't want things to crash on you with the influx of patients, and let's say you had to increase the Wi-Fi bandwidth. Restructuring of your existing space to accommodate social distancing, to keep your staff safe, like I said, with those plexiglass dividers, or maybe even additional technology so that you can sync better with the local hospitals to make sure that you're transferring records a little bit more readily. So all of those, if you're following all of those terms and conditions, which you agreed to, then you should be good. Make sure you're keeping track of all that, okay? So what do you expect from the terms and conditions, and how does that translate into the reporting requirements? Well, let's take a look. So HHS has said that the reporting requirements will apply to any providers, any recipients that received $10,000 or more in funds from the Provider Relief Fund. Now that is in aggregate. So if you received some from phase 1 and you applied for phase 2, and then you also got some from a targeted distribution, and let's say all 3 of those add up to more than $10,000, must maintain all documentation pertaining to costs and expenditures on funds used. And I hit on that on the last slide, but just make sure that all of those in the terms and conditions, and you can reference back to that slide, make sure you're keeping detailed documentation of that. Number 3, the documentation portal is anticipated to be open on October 1st. So I know that's coming up in now less than a month. So you can't submit anything yet. The portal is not open. It's not open because they haven't come out with the parameters of the reporting requirements themselves. But make sure you're keeping track of it now so that on October 1st, you can submit your reports. And then details will be forthcoming from HHS. So the next logical question is, when will the reporting requirements be finalized and published? You know, we spend a lot of time at Webster-Rogers keeping up on this stuff, staying kind of taking a pulse on HHS. And what we can tell you with confidence is that we are closer today than we were yesterday, right? So honestly, nobody knows. But with October 1, with that deadline coming quickly, we do anticipate that HHS will publish those reporting requirements pretty quickly. We're hoping within the next 2 weeks or so that everybody has time to look through those, publish guidance on it, and then we can start getting our reports ready. So from us, I would suggest, if you haven't already, subscribe to our newsletter, because that is how we get news out there about upcoming changes, specifically for the Provider Relief Fund. And as Tim and John both said, there's changes every day. So make sure you subscribe to that. And then if you have any questions that you want us to answer personally, definitely reach out to us, and we would love to help you out. So that is it for my presentation. So with that, I'm going to hand it over to Nelda. Nelda, the floor is yours.
All right. Thank y'all again, the wonderful panel of speakers, Tim, John, and Josh. Appreciate it. I think we do have some time to take some questions. If you have anything you want to submit in the chat, Tim is monitoring that and will give some information regarding it. I know we covered a lot of information today. may have questions that come up subsequently as you think through the impacts for your individual organization. But Tim, do you have any questions you want to fill at this time, or any additional information that we wanted to add to the presentation as we're coming to closure here?
We haven't had any submitted in the text box, but in the chat box, but certainly feel free. Or, if you are so bold and want to unmute your microphone and ask something live, we're happy to answer your questions. Right now we have about 4 minutes, and happy to field questions if you have them. Otherwise, we certainly are willing to give you some time back. Oh, one just came in. How do you handle an employee who is on medical leave during this pandemic? So, John, I know we discussed this is probably more of an HR related issue. Do you want to tackle that right quick?
Yeah.
Oh, I'm sorry. It says regarding FTE count. Okay. So they do, if they are on medical leave during the pandemic, they would still count as part of your FTEs because you're still paying them. So if someone's out on medical leave, similar to like if they are on maternity leave, things of that nature, they would still count towards your FTEs in that regard. Another good question, are mental health service providers eligible for HHS provider relief fund dollars? Josh or Nelda, do you want to take that on? Josh?
Yeah, that's a great question. So the short answer is maybe. It depends not so much on your specialty, it depends more on how you bill. So if you bill for Medicare or Medicaid, then more than likely you are eligible for some provider relief funds. What I would suggest to you is to go on to HHS's website, and you can validate whether or not you're eligible by entering your TIN, your tax ID number. Or if you want, feel free to reach out to us and I can help walk you through.
All right, excellent. Another good question came in. HHS original distribution that we didn't apply for, if I understand correctly, we now need to meet the terms or we need to pay it back, question mark. Is that right? So they didn't originally apply, they just got it. Do they still have to follow the terms? Or if they don't, can they still pay it back?
Yeah, so, and that's kind of making a deal with the devil is kind of what I was saying earlier. That's how a lot of providers feel, is that they received this money and yeah, they used it, they needed it, but they were kind of forced to accept the terms and conditions. But ultimately, yeah, if you agreed to the terms and conditions and you use the money, then yes, you have to abide by the terms and conditions, or eventually you might face an audit to make sure that you pay that money back.
And if I'm not mistaken, even if you didn't go in and certify yourself after receiving the original distribution, wasn't there a time point where they basically said you basically default, if you've kept the funds, that you default to agree to the terms? Is that correct?
Right. Yep.
Josh, I would like to just add that there is a process that's been kind of developed through HHS to further help providers walk through the process of repaying it. So if you would like to go ahead and check on the frequently asked questions, you may find some updated information there on how, if you've determined you want to return it, how they will walk you through the process for returning it.
One thing I'll mention too, the latest thing to come out about the employee Social Security deferral, I'm sure employers are going to be hit by individuals who have heard about this and request it, but they have to keep in mind that you're deferring taxes from September 1st to December 31st. Those taxes are to be repaid in the first quarter of next year. So they're basically going to double up on your withholding in the first part of next year, in the first quarter, to catch up for what was, deferred at the end of this year. So it's not as great a benefit as some people might think it is. I think a lot of people would just prefer to have the steady income throughout. But it is something that some employers are asking their employees to sign a statement, basically stating that they recognize how that's going to be withheld from them later. So they'll be withholding basically at 12.4% instead of 6.2% come January. So that's something to keep in mind. But there'll be more regulations coming out on that too, I'm sure. And there's the possibility they'll forgive it. You just don't know.
those were definitely some good questions, and I think we're about to the end. I would like to remind everyone that we do have our next scheduled one coming up in 2 weeks from now. Additional information you can find on the South Carolina MGMA website and the Webster-Rogers website. Again, I appreciate the opportunity for us to be part of providing ongoing education for MGMA. Appreciate your attendance and your participation on questions. You can reach out to any of our contact numbers as you need to, as well as our general question. Again, if we did not get a chance to address your questions, we will definitely follow up with you directly. Again, thank you, everybody, particularly.
All right.
All right,
Thank you, guys. And Lisa, I see your question. I'm going to respond to you right quick.
All right, thank you. This concludes the presentation.
All right, thanks everybody.